Hello and welcome back to the ROI Club. This is a premier presentation for the premium ROI Club members. So I hope you enjoy it. This accompanies a Hello and welcome back to the ROI Club. Today we are looking at a stock analysis uh, on the MSB Trust. Very, very interesting company I've just taken a position in, and it's for the premium ROI Club members that are part of the wonderful group in the Substack. So let's get into it. Disclaimer, nothing that I say here is advice, guys. It's just my opinions, documenting them with the world. Seek professional advice, which this is not, before making any decisions. I've been thinking a lot this year about copper. Didn't really have a way that I was confident in which to play the theme. I watched it go below $4 and I still was not particularly interested. Since then, it's gone on a tear, and it it makes me think about, is there an indirect way for me to play copper? Because I'm still not really liking, and now that it's expensive, I still don't really like many of the ways that a lot of people are opting to play it. So I started to see these sorts of things, and this was on Twitter, copper versus iron ore. And it seems to me that iron ore is a reasonable way to capture most of the upside of copper, and that makes perfect sense when you think about them both as industrial metals. And yet, iron ore seems to be very, very unloved, probably on fears of Chinese economic growth slowing. But if we think about the longer term industrialization of the world, both in the emerging markets, electrification theme, and of course in developing markets, or developed markets, I should say, having to revamp their infrastructure, iron ore is still going to be key in all of those themes because steel will be required. So I'm looking closer and closer at iron, and I think to myself, if there's a way I could play a royalty for this sort of thing that's reasonably priced, I'd be very, very happy. There are some cheap producers that I think have a lot of talk. I'm still looking over them, and we'll keep you updated. So iron ore relative to copper, this is just a ratio, a relative valuation. How many units of copper are required to purchase iron ore based on any of these historic dates? And as you can see, we're starting to bump along what has formed, I guess, a near-term bottom. So post 2021, this is roughly as cheap as iron ore has gotten compared to copper. And if we look at this bit further out and on a percentage basis, we can see that copper's gone on a tear, up 78%, whereas iron ore has lagged below 20%. And if we think about the slightly similar use cases, I know they're not exactly the same, but in terms of industrialization, that key theme would apply to both these metals. I think it's an opportunity for iron ore. So here's a one page on the company. and it's a trust, really. I shouldn't call it a company, but you get the idea. The enterprise value less than the market cap, so they have net cash balance. 198 million enterprise value for something like this. It's a tiny, tiny investment opportunity with the margins that I want to draw your attention to. So the gross margins are 100%. As my uncle Rick Rule would say, your gross is your net. Your return on equity is above 100%, and your return on invested capital in the 90s over the last 12 months. If that doesn't make sense to you, you've got to think about what this company, how it operates. Okay. And I'm going to explain that in just a moment. So, my exact summary for Masabi is it's a trust that's purely created to receive royalty agreements from the iron ore production of one mine only. So, that's a risk in Minnesota, the Peter Mitchell mine. That mine is operated by North Shore Mining Co., a subsidiary of Cleveland Cliffs. So, decades ago, this trust was set up. The trust received a capital. They cut a check using that startup capital to these operators here in Minnesota to help them get the mine up and running. So, upfront capital, done. From there, they receive royalty payments. And in addition to what's important about that, they really don't have ongoing expenses. All they've got to do is administer the trust, and then they flow through all the distributions. So they receive the royalty. They don't have to pay any more every year to operate the mine. They just get their check, and then they give it to unit holders. What you've got to understand is that in these pass-through entities, Whether or not it can make sense for you as an income play depends on you at the individual level and how you've structured your investment portfolio in terms of your brokerage. So if you're investing in your individual account in your individual name, it'll depend on where you are in the world. And if you're using a corporation, then again, it's going to depend on corporate law, how they tax unit distributions or dividends. So just something for you to keep in mind. It will depend based on where you are in the world. The investment thesis, it's a classic asset light inflation beneficiary, and it's one that I came across reading the works of Murray Stahl and James Davalos a couple of years ago. I've been shorting puts on it. I've never been assigned, but now I would like to really take ownership of this thing. I think it's going to be a wonderful business to own in the future. It's flat capped expenses for reasons that I mentioned, but the royalty will rise in response to inflating iron ore prices and volumes. And the iron ore price has had a compounded average annual growth rate of over 11% since 2000. So that's significant. So the iron ore price is rising. These guys are getting a benefit of that. And presumably, they will be able to expand and slightly improve their volume operations over an inflationary period. So they've got these kind of two key growth drivers, I would say, in addition to which it is likely, not certain, but it's likely that in a bull market for commodities, the market would be willing to pay a higher multiple for this type of business, particularly given the return on equity and the margins that I mentioned. That hopefully gives you an understanding as to why the return on equity can be above 100% because you don't have to put any more equity into the business. You don't have to finance any more of this one operation. They haven't gone and created any more royalty agreements. It's one and done. And so you just continually receive those royalty agreements in perpetuity until either the contract ends or the mine ends. Unless there's a shutdown, which has happened here. We'll talk about that in a second. I would expect 80% operating margin on growing cash flows at least. I think that's fairly conservative. And I think that they can continue to grow their reserve base per share. So, according to what I understand, initially there was estimated to be about 400 million tons of reserves. Over 10 years, they've done roughly 4 million a year in terms of tons. So you'd expect that to have reduced. But actually, what it's done is it's expanded almost double the initial reserve base because they've come up with better ways of extracting and they've also come up with better ways of discovering more iron in this particular mine. So reserves are up, net asset values up, with again no more capex needed on Masabi's behalf. The life of mine. So, how long can this thing go on for? It's estimated, according to my sources, at about 48 years with the annual production. And that's around about using a stay flat production of around about 5 million tons of pellets. It's currently doing 3.5 to 4 million tons per year. Here's a visual just on how amazing their margins are. It's a set up a business, collect your check, and just forget about it year on year on year on year, except for when they had a little dispute with Cleveland Cliffs. So the margins just do not change, whether it's inflationary or deflationary environment. These guys really don't care. They get their royalty. That may be a bigger or smaller number in terms of the aggregate dollar amounts of their revenues based on how much the mine sells and the prices at which they can sell. But inflation eating through the expense column is not an issue for these guys. So what happened here? Well, Cleveland decided that they would be smart and they didn't like the royalties that they were paying to Masabi, so they decided to close down that mine and focus on other operations. And there's been legal disputes since apparently has been resolved, and the mine is back into production because the company's still earning. That's my understanding of it. Obviously, that could change, and I will be delving into it into further detail, and it's something that you should be aware of as a potential risk factor. Okay, so don't take my word. Do your own due diligence. How am I playing it? Well, given the fact that the structure is set up as an income and distribution type of instrument, it's very good if you're looking for income, right? So I'm mainly looking at this as an income play, so it's a smaller allocation, but it does have a large reserve life that they've been able to grow and high margins that are not really going to change based on the operating business model. So I'm buying some equity and I'm selling options, both more put options to potentially get a greater exposure at a cheaper price, and then out of the money um, covered calls to really juice the yield. I don't want to be assigned right now. I think that, and I'll show you my valuation in a second, there's quite a bit more for this equity to rise, and I don't want to be assigned too early. So I'm going to be writing these options out of the money for just a little bit of extra juice on the yield, and I'm actually going to be reinvesting the premium into buying more shares. So, how does it work? On the back of the envelope, if you've got 4 million tons at an average of 94 bucks a ton, and I think that that can hold up. That's not an unreasonable estimate, I don't think, because this was the average across the board around the world for 2019, so pre-COVID. So, given everything that's happened on the inflationary front, I don't think we're going to see many sustained periods of time where you're going to have these commodities trading for less than what they were pre COVID. Because if you adjust the nominal valuations, that is something that suggests you really need to look at a higher normal. 2.5% is the royalty that they receive on the first million tons, right? And then you've got 2.5 to 6% on a sliding scale between 1 to 4 million tons that are produced by the mine. And then if the mine has a bumpy year and they produce over 6 million, then they get 6% of the sales. If you look at the average revenue over 2017 to 2024, this is another way you can kind of smooth it out to see whether your estimates are reasonable. So you can say, okay, well, average of these years that have been good, bad, and mine shut down and all this sort of stuff, you've looked like 30 million as a reasonable revenue number. So 30.5 million as an average estimate, smooth across the board, year in, year out, seems reasonable. Okay. So roughly 7.63 million per ton of production. Okay. Remember, it's a sliding scale, but we're just trying to smooth things out to see what might be reasonable. So 30 million revenue, 80% margin for this type of business, very, very, very achievable. And all they've got to do is pay for the administrating of the trust and to flow through the earnings, and that's it. You're looking at roughly 24 million divided by 13.2 million shares on issue or trust units on issue. That works out to be roughly $1.80 per share. Okay, simple. So, very conservatively, this business could be expected to do on average $1.8 of earnings per share, a PE of 12. So, a PE, an earnings yield of what is that, 8.5%? And for a company that has, in reality, they really have closer to 90% net income margin. I think that that's very, very reasonable. The S&P has a much lower earning yield and trades for much higher multiples. And so that would suggest a price target of somewhere around $28.81 as of now. Obviously, the valuation of that will change if you think that there's going to be a higher floor price for iron ore, which could well be the case. If you think there's going to be a higher premium paid for royalty type companies that we're going to go into, that number could easily be higher and it could continue to actually grow regardless of whatever the share price does in the meantime. So if you look at the enterprise value as opposed to the share price, remember we're going to add back the cash, or so we're going to subtract the cash from the market cap, divide it by the shares. You're actually only paying $15.09 for the pure royalty operation. So you're getting some cash, and if you subtract the cash off the current share price, you're only paying an equivalent of $15.09 for the business alone. So if you use that crude back of the envelope calculation, there's an argument to be made for 45% upside. Plus, you're getting around about an 8% dividend yield, it works out to be at the moment. And if you could juice that with a few covered calls, as long as you don't get assigned too soon and too close to the money, this could be a real compounding machine. If you take the premium from the covered call and all the dividend and you start to buy back more shares and the company continues to execute over time, then I think this is a very interesting opportunity. So I've taken a position. I'm hoping to grow it, and depending on what happens in the future, it's a great, great opportunity for income if you're an income investor. And what can I say? Here's a look at the price. The thing is traded up, double from where it is today, and I think that we can easily get back there, and there's no reason why not. Ownership, so you're looking at Horizon Kinetic own nearly a fifth of the funds. My verdict is that I'm long the stock, as I've said, and its quality is predictable. It's an inflation beneficiary that's asset light. It's been able to grow its net asset value, and it's trading at a discount, I believe, to what it should be trading at. And I see this as a get paid to wait with very little risk, other than, of course, it's only the one royalty. So if something happens to the mine, the earnings go away. That being said, the mine has a very long reserve life. The company will really need to continue operating with that mine because it's high quality ore. And given that Ukraine is out of action in terms of producing iron ore, that was the third biggest producer. I think that the future looks pretty bright for most American steel companies. And so that's that. Hopefully you enjoy that. If you do, please do like and subscribe. And if you could share that with the world, I would be very appreciative. Thanks for your time, and I'll see you in another publication shortly.